Evening and welcome to a Darwin Innovation Hub look at the venture capital investment landscape in 2026. I'm Dante St James, currently sitting with flu in a Perth hotel at the moment and heading back to Darwin very soon. Hopefully, I'm not going to be too stuck in the cold south for much longer. What we're looking at is a bit about how venture capital is looking in Australia at the moment, what's getting funded, and perhaps how you can make use of that information for your potential startup on the way. So the four things I want you to take home after this is a real map of where the money seems to be landing in Australia by the category and the postcode. So we can look at around the different parts of Australia, what seems to be cutting through. A bit of a test about whether your product survives being copied, and that's certainly a big deal when it comes to working with the vibe-coded software projects at the moment. And then there's a money map, why half your list cannot say yes. That'll make a lot more sense soon. And looking at opening doors, particularly in the Northern Territory, Western Australia, and Queensland, where I'm mostly working at the moment, and how those vehicles are being built for founders in those areas. So the map that everyone gets wrong when it comes to venture capital at the moment is very much around about this number that everyone's quoting, which is, the $1.8 billion of investment that's gone in Australia since 2022. It's our strongest quarter since 2022. And while that is correct, it's also a little bit misleading because it doesn't mean there's tons of money out there going to lots of different things. It just means there's tons of money out there, but it's not going to everything, because what's happening is that there is more money around, yes, but fewer companies are taking it. 20% down the amount of deals that have happened between 2024 and 2025, but there's 63% more capital in 2025 as opposed to 2024. So more money, less companies are getting it. Only one of those two facts makes the headline. They say, oh yeah, 63% more capital, but they're not really reporting on the fact that it's a lot less companies are sharing in the capital that's being given out. So what does that mean? Well, the top 20 deals of Australia over the last year took the 79% of all the value in venture capital, which is, going to be really hard to try to reconcile when you think, holy crap, that means that like some companies got a lot and the rest got very, very little at all. 21%, the remainder got the other 87 rounds. So if there was like 87 rounds, another top 20, so we're looking at around about 107 rounds of funding. One deal, if you look at this, actually took home 11% of it. So over 10% of that entire market of venture capital took home like over 10% of it. So that's really, really interesting. What you can start to see is that if we start off with the 10 largest deals, it only left less than $1 billion. So not quite three-quarters of $1 billion left for rounds. So 60% was captured in just 10 deals. But we see then that 33% was captured. So a third of all the capital was chewed up in just 5 deals. That's crazy. So once you get up to these high numbers, you start to say there wasn't really a lot left for anyone in there. And I'll be able to send this all to you. If you register for this webinar, I'll send you through all these pieces of information, all the rounds of where we got the information, and how you can sort of see how the venture capital funds are playing out at the moment in Australia. A lot more money, but a lot less companies getting it. 3 trackers you can look at is a local analysis between $7 and $8 billion going out in funding. The deal room about 3.9 billion. This will all make sense a little bit later. And the traction, we're looking at 1.77 billion. So 3 trackers across the markets saying completely different things, but they're actually counting different things. What we need to do is to trust the direction, not the amount that's showing in there, where it's all actually heading. And where it's heading is, well, to very, very different things we may have concluded it used to. We think of venture capital as all about Ubers and Facebooks and software development, but really what's happening is that vertical business software, did take a lot in the last 12 months. Doesn't mean that software is hot right now. It means a very specific kind of software is hot right now, followed by hardware, robotics, and sensors, then space and defense, cyber compliance and identity. And then things like health tech, surprisingly, climate and energy tech, consumer brands, really quite low in the amount of money that was invested in it over the last 12 months. And in this first quarter of the year, this year, that vertical business software really was very strong. But you've got to understand first up what vertical business software is. And it's software that applies to very specific circumstances, to very specific verticals. So not to general business software like here's an app to help people meet each other in remote areas. It's very much about here's software that specifically helps to understand the data coming from diagnostic machines in nuclear medicine. So it's really, really specific kind of software that has a very high cost and a very low user count to it. Not stuff that's looking for mass adoption by anyone. So the new unicorns aren't really software as a service as we used to think. They're not the HubSpots, they're not the Wixes, they're not those kind of platforms. They're more around things to do with advanced navigation. About $1.5 billion of the funding went to advanced navigation and autonomous systems. So we're talking about drones, we're talking about underwater drones, we're talking about remote delivery systems, that kind of thing. So not what you would expect. A lot of that would have gone in here. $1.5 billion went to Gilmore Space for their sovereign rocket launch, which is happening out of Bowen in Queensland. So again, space, because of the equatorial adjacent nature of Australia and relatively empty skies, space is hot right now. I know that there was some equatorial launch in Australia was thought to be a bit of a failure at Nhulunbuy in Arnhem Land in Northern Territory, but it just moved out to a different location. So there's new version of equatorial launch being launched near Weipa in Cape York in Queensland. So that's getting a lot of money put into it. And in South Australia, meantime, in the Tonsley precinct and through Lot 14 at the Adelaide University, there's a lot of space stuff there, whether it's space in terms of micro propulsion systems such as Aliena, which is out of Singapore, but also has a presence in the Northern Territory and elsewhere through investment and through testing, through to satellite imagery and quantum gravimetry that's a little bit closer to Earth. Niara, which got $1.1 billion, is infrastructure modeling for utilities. So things like that may be put into specific use cases just for very large infrastructure, such as well, the utilities, water, power, sewage, and communications. So we're looking at very big kind of things that are getting money, not little software as a service projects, and just not getting that much money attracted to them. There are some deals here and there that certainly do cut through, and those are ones that tend to cut into very specific market segments that are very high value. So they're, you think about the high value projects going on in Northern Australia right now, including the gas extraction from the Beetaloo Basin. We're talking around the building of data centers and very large scale data centers in the Barkly region of Northern Territory. We're talking about, more oil and gas exploration off the Northwest Shelf that seems to be firing up now that we're looking for more sovereign capability of holding on to our energy resources. So some of that stuff is certainly firing up, but it's not just, it's like the old saying where you go, there was a bunch of people who made money out of mining for the gold, but the people who made the best money were those who sold the picks and the shovels. That's kind of what we're looking at here. Those who are building software that is not software as a service like we think of it with mass user platforms, software as a service for very, very specific things to do with modeling infrastructure, planning trajectories and navigation, that kind of thing. Very, very different to what we think of as software as a service. For AI, 1/5 of deals got most of the money. So AI is still pretty hot at the moment. That has cooled off in the last quarter quite significantly. And this current quarter seems to be showing a lot of that as well, as AI tends to be gearing more towards sovereign capability rather than just, oh, here's another service we're going to whack over the top of existing AI models. Like, I'm going to build this off Anthropic, but I'm going to put a thing over the top of it that's the secret sauce. And when we look at it, it's really just a bunch of prompts and training data that's really got no other value that no one else can build. Like anyone else can build that as well. 20% of deals got 61% of the capital. Not one investor valued AI first lower. So what that means is that what we're looking at is that whilst there was a fair bit of money thrown at AI in Australia, that really it's only the top 20% of deals really took home the vast majority of that. And so it wasn't like lots of little AI related apps, a lot of little AI stuff going on. It's more, again, stuff that's integrated into that software as a service that is vertically integrated into very important major infrastructure markets, or the things that are already attracting a lot of specific funding around sovereign capability or energy resilience or exploration of resources, that kind of thing. So there has been a reckoning of software. There's no doubt about that. I think I'm getting 10 to 15 different pitches every week at the moment that are all basically, I've built another AI app for this specific problem. And you look at it and you go, about 15 other people have done this. And it's usually around trading apps, around futures, about Forex. It's around options trading. It's just trading in general, whether it's crypto trading or whatever you're looking at. It's a lot of it's predictive markets is very hot right now. They're trying to get that sort of fired up and going in Australia with some of the big predictive markets that are going off in Australia, in America at the moment. That's certainly making some moves in Australia. But what happens is that we're starting to see that the products that we go, okay, I've just spent 6 weeks building this particular platform that I think is amazing. We can have people rebuild that before the meeting gets in here. You tell us you want an investment. We could probably get someone in to rebuild that before they hit the ground. We just go, okay, that's what it does. Great. Let's go and make that. And now what we're starting to see is a group called, I think it's Bain Capital in the US. Actually, there's a team of vibe coders that literally take every single thing that is pitched to them, that they sit down and look at that's software. And if they can rebuild it themselves in a couple of days, then they're not going to invest in it. They don't also then go and make that themselves. They just do it just to test out the resilience of that product, the uniqueness of it, whether it has that protective moat around it. If something that you've designed can be done by anyone else with a Claude-coded account, or a Base 44 account, or a Lovable or Replit account, then really that you're looking at something that's utterly uninvestable. And that's going to really upset a lot of people because they've got this idea in their head, and certain ads for certain products like Vanta don't make this any better. But they're going around, they're making claims as, you could get your vibe coded platform acquired for $110 million and you can become, a unicorn overnight, just simply coming up with a great idea and being the first to do it. The reality is that almost anyone can do that. I've released a platform, like a plethora of software over the last year. Some of those things are actually making me money right now and are being really good investments of my time and efforts. Others are just rubbish laying in a scrap heap. There's just so much of it now. We're overwhelmed by it. Software isn't cool anymore. The market moved before the founders did. So what happened is, we're down 19% when it comes to the software value, and also the private equity tech deal value is now gone way down as well. So the amount of money that private equity and venture capital are willing to give to software startups is just crashing. It's like a 69% drop in private equity where they actually want to take on and acquire your technology or your idea. That has absolutely crashed. Like, it's been a massive bloodbath where it's just not getting bought anymore. A little bit less for for some of the earlier in the year, but as it's got further down the year, as it's becoming very, very obvious to all and sundry that we're losing a lot of the capability to protect our software that we're building from people being able to just easily replicate it. That's just crashing out. The code is not the moat anymore. Software is not dead on its own. It's just the advantage moved from being, here's my lump of code that I think is really great, and it's going to take years before someone can come and catch up with me. Now that's just replicable just by simply going, well, I've got an idea. I'm going to build code around it. I'm going to put it on web hosting. I could probably even run a very short little prototype on Cloudflare pages or GitHub pages and run it over to Netify and maybe just like make it easily able to be scaled. Or it becomes a marketing game and an ability for you to move faster than anyone else to get a market share. The problem is that there's always going to be someone else who comes along and does that for you and bites away. And instead of there being one competitor biting away at you, like Uber having Lyft or Didi biting away at them, it's going to be 50,000 competitors biting away because they see you making money, They want a piece of that, and they're going to find a way to outmarket you, outmaneuver you, and get in front of more people until finally those people realize that they can just get their own team to do it themselves. So what we're seeing is I'll move to the vertical as opposed to the horizontal. And by vertical, we means it's a whole workflow that just works in this one industry. Let's just say it is monitoring gas extraction units on the Beetaloo Basin in the Barkly region of the Northern Territory, perhaps, or in the on the Catherine Big Rivers region. And it's only for that thing, but it's extremely valuable for that. So you've got a lot less people, but they've got a lot of that workflow. It's just so good for them. Where we see a lot of general purpose software, a lot of general purpose apps, just not getting any of that. And the excitement is very much for the vertical as opposed to the horizontal. The capital is extremely excited about the vertical. So where this switches around from, here's a really smart person who knows how to write software, which we've seen a lot of in the past. Now we're moving to, here's an extremely connected person in an industry who sees a problem and needs to solve it for this specific industry, a very high value industry with a very big desire to spend. That's where you're starting to see with the capital flowing. The excitement, yes, is pretty good. The capital is definitely flowing there. And the deals around about matching to the capital, 76% of that software flow is going into those vertical software systems. So you're talking about the things that solve very specific problems for very high value clients and customers and companies, rather than mass appeal stuff that doesn't really, add value to anything. So for instance, anything that's like a dating app, or anything that's like communities and things that require 1 million people to be present on it in order for it to make advertising money. In fact, anything that needs advertising and subscriptions to be able to pay for it, as opposed to a full suite of services that you can deliver for that particular industry, you're looking at really struggling to get any sort of deals. So what we need to do is pretty much go, okay, here's a test to see if someone can just come in and replicate what we're doing. A lot of that's to do with proprietary data. Do we have proprietary data that improves as our customers use it? Because as customers use it, we get data that helps us to better build that moat around us. That's a good thing. Or maybe it's something that's bound by regulations. So yeah, that could be if there's something which is matching new regulations. So for instance, if there's if you decided to base your new app on an accounting software that is designed to take advantage of changes towards same day payroll, payday super, I think it is one of the new things that came in with financial like accountants and accounting systems. Well, that could be a good thing, but the problem is all the existing players like Xero, MyOb, and Reckon are already integrating that in as well. If you've got multi-year contracts or a bit of a procurement history coming into there, that could be good. These are all things. Notice that very little of this has to do with the actual software itself. So a regulated compliance-bound process, multi-year contracts, a system of record, like you hold the data as opposed to just having a pretty front end, deep ownership of a customer's workflow, distribution that you control, you don't rent, switching costs the customer would feel. So for instance, you get people in, it's very hard for them to switch away. I've got it with Xero at the moment. I'm sick of paying their incredibly out of control pricing. But the reality is it's really hard for me to switch away from Xero to a cheaper system because Xero is just so damn good and sticky. And I kind of feel, oh God, I'll just keep paying extra when I need it. Where you control the execution and not just the display. This is the sort of stuff that now survives being replicated. But what most people are doing when they build software, they're just basing it off, oh, well, I've got proprietary data that improves as customers use it. And that shows that only the code was doing the work, none of the other stuff, the work that's outside the system itself, the regulatory backbone or the distribution of your software, or the stickiness of it, or the fact that you are so deeply ingrained into a customer's workflow or an industry's workflow that you can then protect yourself to get to the point where you're going, I don't even need to have a lot of data because I still survive a copy. So that one you can play with yourself and ask yourself those deep questions, whether that's something that you actually go for. Like, is that something you solve, something you actually can hold? Atoms and geography are big, particularly in the three markets that I looked at: Queensland, Western Australia, and Northern Territory. We're looking at where hardware is the most funded and also the most refused thing that we look at. So, about $303 million going into the second biggest category, which is hardware. 31% of VCs also exclude it. So, it's the second biggest category in terms of numbers, but also is the most refused. And a lot of this can be due to a lot of Southern, particularly Sydney and Melbourne based venture capital funds being very heavily invested into software. They understand it, they get it. And when some of your more hardware oriented venture capital firms who are not the big ones that we're used to, who are very much around the hardware, things that are very hard to replicate because they require years of research and investment and building. That's where you start to see that they're the ones that seem to go and look at it. And in the funding view, yes, $303 million and 31% of VCs actually excluding it from their thesis. Look at the thesis, though, it's actually, looks like it's at that $303 million of being the second biggest category makes it a very, very attractive thing for those who already have some experience with it. So you're looking at, not speaking out of school and being particularly biased towards it, but Paspalis is an example of this. It's been funding mostly into hardware, into very vertically integrated industries such as resource extraction, space, drones, remote delivery, remote transportation. Those kind of areas are very hardware centric. And so, whilst many other venture capital funds would overlook them because it's not cool, it's not AI, it's not software as a service, that's where they've been able to swoop in and make quite a killing off that kind of thing. So, by the thesis data, it is, yes, the most excluded category in terms of the venture capital firms that don't really deal with this kind of hardware, but it's now becoming hot because the software has become so not hot recently. Dual use is everything right now. So it's one of those things where it needs to be something that doesn't just open up a commercial market, but it opens up maybe a defense market or a commercial market with a mining market or a government market with a market with a public market. The idea here is that you're not just selling to one customer, you're selling to many. So many of the things that I see coming from ex-government employees who design a piece of software or a process system, it says that basically, I'm going to sell this to the Queensland government. I'm going to sell this to the South Australian government or the Northern Territory government or the Australian government, not realizing as they say that one single customer, whilst it's a big fish, has very, very hard to break into procurement policies. They're just not going to risk everything they've got on a piece of untested software from someone who's never done anything like this before. But when you can find something that works, yes, for government, but also works for another industry that's quite major, that then makes the funding environment feel a little bit more friendly to you. Because not only have you got, maybe, the Commonwealth or a local governments, state government saying they'll prop up some money for this as well because it helps them to solve a problem, but you've got industry like providing in money for that as well. So anything dual use that can go to two different industries, it could be aeronautics, and it could be drones that are delivering cargo in the one. If you have something that goes for both of those markets, then you're much more protected and much more likely to unlock capital than if you were just pitching to this one industry, one government, that kind of thing. And particularly at the moment with a world that's on a sort of a war footing and has been now for the last 5 years and getting more intense, we're very much in that place where there's a lot of money going into defense. Even in Australia, which has typically been quite conservative with defense investment, has now become very much a hotspot for it, mainly because of our isolation from places like the Middle East, but also because we've got a wide open space to test things in, and we have a proximity to Asia that sort of makes us, just far enough away, but just close enough to, in order to be part of that theatre if war does happen to break out. As I don't want to see war. I'm a capitalist, but I hate war, and I think it's really bad for business all around and bad for people. The reality is that's where a lot of money's going right now. So if you've got something you can go into a particular industry and then could also have a defense purpose. So for instance, satellite imagery could be really good for geotechnical surveys, but also it could be good for monitoring coastlines. That's the kind of thing that really unlocks that $1 billion of potential capital that's laying out there at the moment. So what investors already ruled out when it comes to hardware, a lot of them have just said, nah, just going to hardware specialist firms would probably be a good idea. Hardware, particularly that works in with like looking at the funds, what are they already investing in and have invested in over the last few years that is hardware related? Are they heavily invested in space and looking to include, like, it looks like they're actually increasing that? And you've got a space thing, go to those particular funds. But I wouldn't be rocking up to Blackbird and saying, hey, I want to put satellites in the sky when they traditionally have been very heavily involved in software projects or whatever they happen to be doing right now. Moving from hardware to consumer social media, this is high volume stuff that can. It's generally going to those very big venture capital firms that have hundreds of different things they're betting on, and they're really looking at something, one or two things to really carry that. So whilst they may invest, the investments will be quite small, not particularly huge. Crypto and Web3 has dropped quite dramatically simply because there is now a market really just for crypto and crypto native funds. And I put not just crypto in here, but I put a lot of those predictive markets. I look at trading apps, that kind of thing in this bucket as well. Really, you need to go into those funds that are very experienced with this, because any generalist funds or sector agnostic funds just won't have the expertise to be able to help you out with some kind of regulatory bits and pieces you really have to look at. Preclinical biotech has dropped a bit, but that says a lot of that goes from grants at first, so medical research funds, for instance, and then dedicated life sciences funds or pharma venture arms could be looking at quite a lot of this. But a lot of this means that you need to have a definite supply of what your core ingredients are, and then also have data that's already showing this, or perhaps you've got you found a very, very rare molecular combination that you found an alternative source for, which can not just bring it down. So remember that these, if you're going to go up against existing suppliers of very similar compounds, then you're going to be getting into a bit of trouble when you hit against those existing players who want to keep the price high. Not that there's some kind of global cartel like there is in oil when it comes to pharmaceutical ingredients, but honestly, if people are making billions of dollars out of a very limited supply of a very rare and very valuable chemical, and you come along and provide it at 10% of the cost, well, there's going to be movement in that market. So, and they're probably going to, leverage what position they have in that market against you. Gambling and the vices, like the beer, like, I don't know, probably looking at funding, craft beer company. No one's going to fund a craft beer company, by the way, now. They are so overdone and so done to death, and Gen Z aren't drinking beer. So, that kind of stuff is completely gone. Gambling is really, really special. This is where I now look at not just gambling as in gambling machines, poker machines, slot machines, and gambling sites. I'm now talking about futures trading and trading apps as well falling into this. This would need very specialist sector advisors who've done quite a lot of this as well, or at least are happy to provide the funding outside. Now, there's also a lot of those institutions won't want to actually look at this. So, for instance, your superannuation funds, who are some of the biggest investors in Australia that are limited partners in quite big venture capital firm funds, they will avoid these because they don't want to be associated with them. So there could be a lot of that. And especially for impact funds, they're doing what the activist funds are not going to let you anywhere near that. So it's a very small amount that would look at that. Real estate, well, property tech is fine. It's doing fine. So we're not talking about buying investment property here. We're talking about the things that support us. So property tech is fine. It's very light on assets, which means if it's not asset heavy, where it needs lots of compute power, lots of data centers and all that, well, then it's probably going to be something which is quite attractive. But if it is something that requires a lot of assets and a lot of money, you probably need like the family offices or the real estate private equity to buy into that. So if you've got large property investment firms looking for software that does what they need it to do, which could be, market analysis, it could be sales software, it could be identification of investors, that kind of thing, that's where you could sort of see something in there. Pure marketplace stuff where it's honestly, yeah, where you're using a marketplace to sell things, think the Amazons, the eBays, all those kind of things. If you're just opening up a marketplace, not a dual marketplace, because dual marketplace can be really hard and no one really likes to invest in it, where you've got to go for other people who are advertising on the marketplace and then the people who are then like, you know, the people who are accessing the marketplace as large corporate enterprise sellers. That's really hard to work with and quite often these days does not get invested into. But where it's just a pure marketplace where the defensible layer is really around the data you have and how valuable that is to keep you ahead of the game and everyone else. Your payments are like you're getting really good micro payments out of it, very strong cash flow to come from it, and a good solid workflow that means that you can outperform others. So I would say a marketplace would be something like Go Locum as an app which has been invested in the Northern Territory, which is about getting doctors, locum doctors, into hospitals in remote places and country and regional places a lot quicker than the existing networks through like primary healthcare networks and recruitment agencies. It could take 3 to 6 months to place a doctor. The workflow that the Go Locum has got has mean they can get someone in there in 2 weeks. That's really, really different. And it's got such a strong point of difference that they can make the same amount of money as the agencies can, but have 2 weeks of work instead of 3 to 6 months of work. So that kind of stuff needs to be really strongly supported. The ad supported market has crashed. Um, Investors who have got very strong scale experience and understand how to get you so many eyes on that app and so many people, like, you have no idea sometimes how hard it is to get someone to put a new app on their phone. So if there's a new app that requires you to get lots and lots of people on it, you probably need to go to investors who have got a lot of deep experience of working with big platforms that have lots of people on them and lots of consumers on those platforms, as opposed to selling it to a couple of big customers that pay a lot of money. This is the other way. Ads need lots of eyeballs, and ad supported software is going to be very hard to get invested in now that we're pretty much settled into where we have our eyes and ears. We're on TikTok, we're on Facebook, we're on YouTube. We're not really looking for carving out extra time to be entertained by or watching or doing even more things that sit outside our main apps that live on our phone. Pretty much 9% of the funding landed outside of Victoria, New South Wales, and Queensland. That's pretty like terrifying. So what it is 91% of funding went to Victoria, New South Wales, and Queensland startups. Western Australia, South Australia, Tasmania, and Northern Territory got the rest, which is 9%. So if you're located outside of those main centers, it may seem like it's a little bit of a useless venture to try and get something started. That's only because remember that there was just a few companies that got most of the funding, and they just so happen to be Sydney and Melbourne and Queensland based, right? So we're really looking at the idea that maybe in those regional areas where you're looking at, the Northern Territory, Western Australia, North Queensland, South Australia, Tasmania, that it's also less competitive to get the money that is available there. So don't let this necessarily be discouraging to you if you're outside those big markets. There's less money to go around in those markets, but there's also a hell of a lot less people competing for that money as well. The gravity well, there was a lot that landed in Victoria, but 70% of the national total went to those two markets. And while you look at Queensland being included in the top three, look at the difference between New South Wales and Queensland there. So Victoria did land the big fish this year, but that was really in terms of like one or two major investments that were made that really tipped them over the top. Usually it's New South Wales, and probably will be in the next quarter, as one New South Wales company raised a really, really big round of money, and it sort of kicks it back around again. That said, it would take quite a lot for very large rounds to land in Queensland or anywhere else, simply because the systems aren't quite there, and the deal flow coming through is not quite as refined as what it would be in those bigger markets. Outside Sydney and Melbourne, about $10 million is dropped in by the local jobs fund matched by Paspalis, the Paspalis co-investment fund. That hasn't all been distributed quite yet. So there's still some money left in the bank there. It's about $5 million maximum per business in the territory. It tends to be what is done. A little bit more, so maybe about $6 million has gone in at some point to a couple of the investments through Paspalis. There's a $1 million venture capital investment up for grab every year in Croc Pitch, which is the pitching competition through Paspalis and the Darwin Innovation Hub. You don't have to live in the territory to do these things to get access to any of those funds, really. There's more funds available than just that 5 million. There's always new venture capital, new funds coming available in the Northern Territory specifically through Paspalis. So that's not the limit of what the funds are that are available, but that $1 million certainly does take, it's a big chunk every year. And in the last couple of years, that 1 million has actually become like a 2 to 3 million as the winner and also runners up, and maybe even the third place getter in last year's case end up getting invested in as well. In Western Australia, 38 venture funds are based in Perth. We've only got the one based in the Northern Territory. So you're starting to see a very big difference in the volume. 45 million was allocated across those different firms. So when you think about that, 38 venture funds, but only $45 million was allocated. That means that the average deal is not that big in Western Australia, which is really disappointing. But that's also because it's not so much venture firms that are doing the investing in Western Australia. You're seeing a lot of industry-based investments through venture funds, which are sort of within BHP or within Santos or within the different giants that are located in Perth, where they won't be counted as a venture capital fund, more like an internal investment, I guess. And that's where that looks a little bit different. So it's a little bit misleading there. $2.56 million of innovation pathways coming through the Western Australian government as well this year. So there's a bit of money going in there to starting to do that, but it's actually, there's not that much capital present. And the appetite for venture and risk is very, very thin in Western Australia. It tends to go mostly to mining operations stuff. Queensland, 417 million, so a bit more there, up 37%. So it's actually risen a lot. Only 22% going to women founder teams. So there's a very big push in Queensland to get the female founder narrative much stronger. And the Queensland Investment Corporation, QIC, had about 130 million that they're unlocking with a $200 million fund matched. So they've got another $70 million that they are yet to match with outside investment, with co-investment with other venture funds and investors. So the advantage in Queensland is a lot less competitive to get there. Same with Western Australia and in the Northern Territory, but in Queensland particularly, there's a lot less competition for the funds there. Unlike in small business land, where there's a lot of competition in Queensland every time that a government grant becomes available, it's really the lower competition for the capital is the biggest advantage you have there. The money tends to move through to those who can say yes. So 18% of funds that are out there can lead the investment round. They'll become the first investor and they're happy to become that. But that means that just about everyone else is not really willing to be the very first investor. 34% are flexible to the lead or follow. So they might lead, they prefer to follow though. And look, almost half of them only follow. They never set the terms. They never actually be the first investor. They're waiting for someone else to walk onto the dance floor and lead that dance, not them specifically. So understand that only 18% of people are looking to become your first investor of those funds, which means that there's tends to be a lot of competition for those funds when it comes to getting the first round of money. Your second round of money sits in the rest of them. So that second round, it's always the way, really. The first round of money is the hardest to get. The second round is always a lot easier. Once you've got someone to say yes, that means that they can look at that. And because of the fiduciary responsibilities in Australia for these funds to follow being very stringent and very tight, it means that, if they've already done their due diligence on you, then you must be okay. And this happens, from speaking from the Paspalis perspective. Yes, we're considered to be a strong due diligence house. So others will look at that and go, if you've done that, well, then that's probably very good for you as well. Running your own list through it, bearing if you've got a list of people that you're going to reach out to, let's say you've got 50 different venture capital funds, that means only 9 of them are going to be able to be a lead investor. 17 could maybe convinced, but really, almost most of them cannot commit until it's priced. They want to see someone else go first. So there's a little calculator I'll send you after this if you register for this, so you can sort of run those numbers through. Let's say if you've got 22 different investors you're reaching out for, and you've never had any investment before, there's only really 4 that will seriously look at setting the terms and actually starting the process of being the first investors in you. So realizing that means you'll start to go towards those who are really the most likely to be open to the idea of being the first investor in your idea. The road to getting funded, 22% of seed funded startups reach Series A. So those who have had seed funding from government grants, maybe seed funding from angel investors or from very early stage venture capital firms, if they've got seed, only 22% of them will actually go to Series A. I know I said it's easier to get the second round of money than the first round of money, but the second round of money is generally a lot bigger than the first round of money as well. So that risk is then far greater. So 22% of those who had seed funding will go on to a Series A. You'll see like in a lot of America, they won't even go for a seed fund. They go straight for that Series A. Series A being the first serious chunk of money. So in Australia, that Series A could be something from 1 million to 10 million. In the US, Series A is going to be 10 million to 20 million at least. And in some cases, their Series A can be in the hundreds of millions of dollars. Just the money is just crazily much bigger. And only 8% of those who went from seed funding will get to Series B. So it starts to get smaller and smaller as you go down there. And the reason being, something as seed funding could look like it's successful, but once it reaches its scale at Series A, may not succeed or may fall down or may not reach its target, something like that. Before you pitch, name the asset you have in your idea that survives someone trying to copy it. Make sure that you own some kind of workflow that's very hard for someone else to get into and replicate. If you used AI to build it, make sure you've shown your security review. But AI building something itself won't be enough. You'll need to also have something that you know can survive someone AI building the same thing that you did. And that usually is the work you've done outside of the technology. So industry exposure, knowledge of that industry, having memoranda of understanding from people who already want to work with you before you've even got that live property, that live software going. That's the kind of thing you need to do. And when you pitch, find the lead investor. Who are the people who are willing to be lead investors? So you'll find that you can just run that in ChatGPT and it'll tell you all about it. Get a warm intro inside their cluster. So if you know who they are, if they're working with incubators, if they're working with accelerators, they're working with innovation hubs or universities, find a way in to get a warm introduction. If your particular category, what you're trying to do, let's say, for instance, you're working in gambling tech or what we call vice tech, go to those specialty firms that deal with this, and you'll know that because it's you can see where the investments are very openly in Australia. So just look for those who have got a record of investing, fairly freely into those kinds of startups before, or go to for government co-investment. They won't generally invest into gambling tech, but they will invest into some other more niche things which have an alignment to some of what their own principles and pillars are. So in Northern Territory, reduction of crime, restoring the territory lifestyle, and also fixing the economy in some way. Those are the 3 major pitches they've got in the Northern Territory. So if you've got something that aligns with something to do with that, you may be able to go into some of the early seed funding, very small seed funding, or perhaps some co-investment from government. Even though government co-investment usually is left to the venture capital firm that they're partnered with to do all the sourcing of deals rather than leading them through government themselves, because government cannot be seen to be promoting or preferencing one idea or one company over another.